March 1933. A man in a wool coat stands outside his local bank before sunrise, hat in hand, passbook folded neatly in his pocket. He has done nothing reckless, no speculation, no gambling, just years of careful deposits from a hardware store he's run since the war. The doors should open at 9. They don't. A small notice hangs behind the glass. Temporarily closed by order of the state. No timeline, no explanation, no access. Behind those locked doors, his money still exists. The ledger says it's there, the numbers haven't changed. But the meaning of those numbers has. Cash in the bank, he realizes, is not the same thing as cash in hand. One is a promise, the other is possession. By the end of that week, thousands of similar doors across America remained shut. Depositors weren't bankrupt, they were frozen, their savings intact on paper, unreachable in practice. And that is the distinction history forces us to confront. When banks fail, where does liquidity actually survive? Most of us inherited a simple belief: the bank is the safest place for money. It's reinforced from childhood. Open an account, deposit your paycheck, let the institution guard what you've earned. After 1933, that belief gained a powerful shield: the creation of the Federal Deposit Insurance Corporation. The FDIC didn't just insure deposits, it restored public confidence. If a bank failed, the government would step in. Your money, up to a limit, was protected. Over time, that protection reshaped psychology. Bank failure became something abstract, almost historical, a black and white photograph problem, not a modern risk. But there's a subtle distinction buried beneath that reassurance. Insurance protects against loss. It does not guarantee immediate access. A bank can be solvent on paper, yet restrict withdrawals. It can be insured and still impose limits. It can hold your funds securely while you remain temporarily locked out. Before 1933, Americans learned this lesson abruptly. After 1933, the guarantee softened the memory. Today, in a world of digital banking, instant transfers, and app-based finance, the distance between deposit and access feels non-existent. Yet history draws a line between solvency and liquidity, between protection and availability. And that line becomes visible only under stress, precisely when people discover what their money actually is. Between 1929 and 1933, more than 9,000 American banks failed. Not struggled, failed. Their doors closed, their vaults sealed, their depositors left waiting in lines that led nowhere. In small towns and major cities alike, access to savings vanished overnight. The numbers in passbooks didn't disappear immediately. What disappeared was the ability to convert those numbers into cash. Bank runs accelerated the collapse. When rumors spread that a bank might be unstable, depositors rushed to withdraw funds. But banks were never designed to withstand everyone asking for their money at once. They operated on fractional reserves. In simple terms, if you deposited $100, the bank did not place that 100 in a vault under your name. It kept a fraction on hand, perhaps $10, and loaned the remaining 90 to businesses, farmers, or homeowners. That system works smoothly as long as withdrawals are staggered and confidence holds. The public believed their money was stored. In reality, it was loaned. On paper, many banks were solvent. Their assets, mortgages, commercial loans, farmland notes, still exceeded their liabilities. But those assets were long-term and illiquid. They could not be instantly converted into cash when depositors demanded it. A bank could be technically sound and still collapse because it lacked immediate liquidity. When trust evaporated, liquidity disappeared faster than capital. Fear moved quicker than balance sheets. Even healthy institutions were dragged under by the speed of collective withdrawal. This is the structural lesson of 1929-1933. Banking is built on confidence. Once that confidence fractures, the mechanism reverses. Deposits become demands, loans become traps, paper solvency becomes irrelevant without accessible cash. So the question history forces us to ask is not simply who failed, but where liquidity actually survived when the system seized. When the banking system convulsed, liquidity did not vanish everywhere at once. It reorganized itself into a quiet hierarchy. At the top was physical currency held outside the banking system. Bills in a drawer, cash in a safe, money that required no intermediary to access. It earned nothing, it carried theft risk, but it was immediately usable. In moments of institutional stress, immediacy outranked yield. Next came short-term U.S. Treasury securities. Backed directly by the federal government, they carried a stronger counterparty than most local banks. While not as frictionless as cash in hand, they represented claims on the entity with taxation power, a higher layer of institutional durability. Then there was the U.S. Postal Savings System. Created in 1911, it allowed citizens to deposit funds at local post offices, with deposits ultimately backed by the federal government. During the worst years of the Depression, deposits into postal savings surged. Why? Because the post office felt tangible and sovereign. It was physically accessible and politically anchored. Confidence migrated there. Below that were diversified multi-bank deposits. Families who split savings across institutions reduced. Exposure to any single failure. Concentration amplified fragility. Distribution diluted it. This is the structural principle the crisis revealed. Liquidity survival depends on two forces, counterparty strength and direct access. The stronger and more sovereign the counterparty, the greater the durability. The more direct the access, the less vulnerable the funds are to institutional bottlenecks. Money did not disappear in 1933. It flowed toward layers that combined trust with accessibility. In 1930, most families did not think in terms of counterparty exposure. They thought in terms of familiarity. The local bank was run by men they knew, attended the same church, sponsored the same town events. Trust was personal, so deposits were concentrated. Entire life savings often sat inside a single institution. When that institution closed, everything froze at once. Payroll funds, emergency reserves, business capital, all trapped behind one set of locked doors. The failure of one counterparty became the failure of an entire household balance sheet. Contrast that with the minority who divided deposits across multiple banks or held portions outside the system entirely. When one institution faltered, they were impaired, not immobilized. Geographic diversification mattered. Institutional diversification mattered even more. Different counterparties fail at different speeds. Today, most people understand diversification in investments. They spread stocks across sectors, bonds across maturities, assets across classes. But very few think about diversifying liquidity itself. Where cash is held often receives less scrutiny than how capital is invested, and that subtle oversight creates hidden fragility. Liquidity concentration turns inconvenience into paralysis. The lesson is quiet but consequential. Redundancy in access matters as much as return. But 1929 wasn't the only time this pattern revealed itself. Argentina, December 2001. The government announced what became known as the Corralito. Bank withdrawals were capped at 250 pesos per week. Transfers abroad were restricted. Lines formed instantly. Officials insisted the measures were temporary, necessary to preserve stability. For ordinary depositors, the effect was immediate. Their savings existed, but they could not reach them. Cyprus, 2013. After years of reckless lending and sovereign debt exposure, banks closed for nearly 2 weeks. When they reopened, large depositors faced bail-ins. A portion of balances above insured thresholds was converted into bank equity to recapitalize. The system. Capital controls limited transfers. The message was clear. Institutional survival came first. Greece, 2015. Amid sovereign debt negotiations, banks shut their doors and imposed daily ATM withdrawal limits. Citizens were told the banking system remained sound. Still, access was rationed. The goal was to prevent systemic collapse by slowing the outflow of liquidity. Lebanon, beginning in 2019, banks did not formally declare insolvency. Instead, they implemented informal withdrawal caps. Dollar deposits could not be withdrawn in dollars. Transfers abroad were blocked. Depositors were offered local currency at unfavorable rates. Access was negotiated, delayed, restricted. Across continents and decades, the mechanics repeat with unnerving consistency. Withdrawal limits appear suddenly. Transfer restrictions follow. Official reassurances precede constraints. The language is always stabilizing, temporary, precautionary, and beneath each case lies the same hierarchy of priorities. Institutions protect liquidity to preserve the system itself. Depositor convenience becomes secondary. Access is throttled. Not because money has vanished overnight, but because the pace of withdrawal threatens institutional survival. This is the recurring structural pattern. In crisis, access becomes political. Decisions about who can withdraw, how much, and in what currency are no longer purely contractual. They are governed by emergency measures, regulatory authority, and systemic triage. The lesson history offers is not that banks always fail. It is that when strain reaches a certain threshold, the rules governing access can change faster than the public expects. Liquidity is preserved by controlling its flow, and that raises a modern question that feels less theoretical than it once did. Today, most money never touches paper. Salaries arrive electronically, bills are paid through apps, transfers clear in seconds, entire households operate without ever handling physical currency. The experience of banking has become frictionless, almost invisible. Convenience has replaced caution. App-based banking reinforces the illusion of permanence. A balance displayed on a screen feels immediate and accessible. Instant transfers create the sense that liquidity is always one tap away. Payroll systems deposit wages automatically. Contactless payments normalize a world where cash feels outdated. But digital efficiency rests on layers of infrastructure few people consider. Centralized clearing systems process transactions, payment networks coordinate settlements, data centers house records, cybersecurity systems defend against intrusion. Each layer introduces a potential point of failure. In 1933, the bank doors did not open. The barrier was physical. Today, the barrier could be digital. An account can be restricted remotely. Transfers can be paused. Systems can be temporarily frozen to preserve stability or investigate anomalies. The experience would look different, but the outcome would feel familiar. Numbers on a screen that cannot be moved. Modern banking is more efficient than anything in 1933. It is also more interconnected. Interconnection increases speed and scale, but it also concentrates risk. A disruption in one node can ripple across the network. The question is no longer whether digital banking is convenient. It is whether convenience has quietly replaced redundancy. The lesson of 1929 is not to abandon banks, it is to understand layers. Layered liquidity means separating convenience from contingency. Everyday transactions can flow through the primary system, but a secondary layer exists for resilience funds positioned so that temporary restrictions in one channel do not halt everything. Counterparty diversification extends that logic. Different institutions operate under different balance sheets, regulatory structures, and risk exposures. Spreading liquidity across multiple counterparties reduces the probability that one decision, one freeze, or one failure immobilizes your entire financial life. A direct physical access buffer plays a quiet but stabilizing role. Not extreme stockpiling, not paranoia, simply recognizing that in moments of uncertainty, immediacy carries value that yield does not. Access without approval has historically ranked higher than interest rates during stress. Treasury-backed instruments represent another structural layer. Claims on sovereign entities with taxation authority carry a different counterparty profile than private institutions. They are not immune to risk, but they occupy a higher rung in the hierarchy of durability. Geographic redundancy matters as well. Different jurisdictions impose different controls at different times. Fragmenting exposure across regions reduces the chance that a single policy shift captures everything simultaneously, and perhaps most importantly, minimal reliance on any single system. No institution, digital platform, or payment rail should represent the sole gateway to liquidity. This is not panic, it is positioning, not withdrawal, but distribution. The objective is not to predict collapse, it is to ensure that if friction appears, optionality remains. When conversations turn to bank stability, people tend to fall into extremes. The first belief is quiet complacency. Banks can't fail anymore. Regulation is tighter, insurance exists, technology is advanced, but history shows that fragility does not disappear, it evolves. Institutions may be stronger than in 1930, yet they remain exposed to credit cycles, policy errors, liquidity squeezes, and systemic shocks. Insurance protects against loss within limits. It does not eliminate friction, delay, or policy intervention. The second belief swings in the opposite direction. Just hold everything in physical cash. But physical concentration carries its own vulnerabilities. Theft risk rises, cash earns nothing and steadily erodes under inflation. Large physical holdings introduce logistical and personal security challenges, and in extreme environments, political exposure can shift toward currency holders as well. Intelligence lies between complacency and reaction. The goal is not to declare the system invincible, nor to abandon it entirely. It is to recognize trade-offs clearly. Every storage choice carries risk, institutional, inflationary, physical, or political. The advantage belongs to those who understand the spectrum and distribute exposure accordingly. Reaction amplifies fragility. Structured positioning reduces it. Fear asks dramatic questions. Clarity asks practical ones. The real question is not, will banks fail? History shows that institutions periodically stumble, merge, freeze, or restructure. Predicting the exact moment is less useful than understanding the impact. A better question is quieter and more revealing. If access froze for 30 days, what happens to me? If payroll deposits paused, if transfers were delayed, if withdrawal limits were imposed, how would obligations be met? Rent, payroll, inventory, medical expenses, which of those depend entirely on uninterrupted digital access? Where are the pressure points? Where is the flexibility? Framed this way, preparedness becomes less about catastrophe and more about continuity. It is not a wager on collapse. It is a stress test on dependency. Optionality is the objective, the ability to root around friction, the capacity to absorb a temporary constraint without cascading consequences. Redundancy is not duplication for its own sake. It is insulation against bottlenecks. 30 days is not the end of a system. It is a window of adjustment. Those who have layers experience inconvenience. Those who rely on a single channel experience paralysis. Structural thinking replaces anxiety with design. And design begins with asking the right question before urgency forces the answer. Return to that morning in March 1933. The man in the wool coat did not lose his money because he speculated recklessly. He lost access because the system around his deposit seized. The vault still held assets. The ledger still recorded balances. But the access layer failed, and with it, the meaning of ownership shifted. That is the quiet lesson of 1933. Money stored inside a system is only as stable as that system's ability and willingness to grant access. The strength of the balance sheet matters. The integrity of the institution matters. But in moments of stress, the access mechanism becomes decisive. What survived the Great Depression was not aggressive positioning. It was layered liquidity, physical currency that required no permission, Treasury-backed claims tied to stronger counterparties, postal savings accounts perceived as sovereign and reachable, diversified deposits that prevented a single failure from freezing everything. Distributed counterparty risk proved more durable than concentrated trust. Redundancy outperformed familiarity. The crisis did not reward those who predicted every detail. It rewarded those who had quietly structured their exposure across layers, and that structural insight has not aged. History rarely repeats itself in identical form. It rhymes in structure. The architecture of banking has evolved since 1933. Regulation is stronger, technology is faster, insurance is formalized, but the underlying mechanics, confidence, liquidity, access, remain unchanged. This is not a prediction of collapse. It is a reminder of design. Systems function smoothly for long stretches, and then, under pressure, they reveal their dependencies. The individuals who fare best are not the ones who panic first or withdraw completely. They are the ones who quietly understand where their exposure sits and how many layers separate them from interruption. Liquidity is not simply a number on a screen. It is the ability to act when action is required. Yield matters, convenience matters, but in moments of stress, access outranks both. The safest cash isn't the one earning the highest yield. It's the one you can still access when others can't. If this changed how you think about liquidity, subscribe.